Hello, everyone. It's Cameron here from the IWF research team, and today I'm going to take you through a session giving you a primer on cryptocurrencies, blockchain, and some of the new developments in that space, such as NFTs, to help equip you in your discussions with clients. So in terms of today's agenda, what we'll be firstly starting with is explaining what a blockchain is, how cryptocurrencies are often a crucial part of that discussion, and then moving on to talk about some of the recent trends and developments in that space, such as the price action we've seen in Bitcoin, and also some of the new developments such as NFTs and the DeFi movement. And lastly, we'll conclude with some of the key risks and consequences that need to be considered when looking into this space. So if we move firstly to look at what is a blockchain. So at a high level, it's essentially a digital record of ownership, and it can be decentralized compared to traditional records. So historically, in an analog world, your file was kept at a bank, for instance, that recorded your ownership, say, of your house. Now, today, those paper files have been supplanted by digital records, but those records are still very much trapped within the bank's computers, servers, or their private cloud, for instance. And so they're still centralized in the bank, so to speak. Now, what decentralized here means, you aren't relying on a single source, such as the bank, to prove ownership. And so if we wanted to illustrate how that idea works, we've got the example on the left here of Jim wanting to send some money to Mary. And so the transaction of sending the money is recorded online as a block of information. Now, what then happens is that block gets distributed across a network of other computers, and those computers run mathematical computations to verify the validity of the transaction. And once they've done so, that block of information is then added to the chain. It gets reconciled across the network of those computers, and it gets sort of added permanently to the chain in that sense. And so what then happens is the record of ownership of that money, previously it was with Jim, and that's what the chain had recorded. And now with the new link to the chain added, that record of ownership is transferred from Jim to Mary. And if we look at how this could be used, a few applications. So property transactions is an obvious one. It doesn't just have to be cash. It could be other assets, such as, for instance, shares and listed investments. And some of you might be familiar with the ASX chess system that gets used for your personal or client holdings of listed securities. The ASX is currently working at producing a private blockchain, if you will, to replace that system, and that process has been underway for a few years now. There are also another example I'll discuss later would be smart contracts, and then lastly, we've got this question of sort of private versus public blockchain. So in a private blockchain is that ASX example I mentioned, and it could be a more efficient means of replacing existing record-keeping methods. Public blockchains are another example. They do carry their own risks, however, and as I'll discuss later on, there are some potential environmental implications as well. Now, in terms of what is a cryptocurrency and how it's relevant to the blockchain, so in order to validate transactions, you need to use increasingly more and more computational power. And there's a cost, not just in the electricity to do so, but also the technology you need over time. It's a bit of an arms race, if you will. We need to constantly upgrade your systems in order to adequately perform the calculations needed to validate the chain. And so to incentivize people to go through that process, cryptocurrencies are rewarded at random for those efforts in mining the chain. And what you typically see is really there's a very broad variability in how complicated these transactions get and how much energy they require. And so, as an example, I've got a link there from the BBC early in the year, where if you look at the entirety of Bitcoin mining as a single construct, then there's an argument to be had that that whole process and endeavor is consuming more electricity than countries, even just because of the amount of complexity of the underlying calculations. It's such that the resources that have been expended have grown to consume that much electricity power, and a lot of that production is centered in China. But the other important thing I wanted to highlight here is that you don't necessarily need sizable cryptocurrency appreciation for blockchains to be viable. Bitcoin in many ways is one of the first cryptocurrencies. Subsequent iterations have seen a lot more efficiency in how they validate transactions on the chain, so they're nowhere near as sort of environmentally damaging as Bitcoin in terms of how they do the entire process, and they don't require anywhere as much energy, for instance. So if we move on to think about why have we seen such a rapid increase in Bitcoin, there's a few factors to consider. Firstly, we've seen a sizable increase in investments in cryptocurrency assets. So that's what the top right-hand chart is showing you. The line there is showing you the growth in total assets under management. You can see since October last year, over the space of little more than 6 months, we've seen crypto asset AUM sort of up 5 times. And so one of the contributors here has been the launching of exchange-listed Bitcoin and another cryptocurrency, Ethereum products. So an example of that is an LIC in the US case known as Grayscale. There's a Bitcoin and an Ethereum Grayscale. We've also seen ETFs or ETNs listed in Canada and elsewhere. Now, one reason you can think of for why this appreciation has occurred is we've seen cryptocurrencies become increasingly financialized. So we've seen a drift from use in actual applications to becoming a tradable commodity. So that's something we've seen in other markets as well, where, say, for example, futures were often originally used to help producers hedge the risk of, say, adverse weather events. But over time, we've seen a grow in speculative interest in that space, and something similar has arguably occurred here. And so in that scenario, the value isn't necessarily intrinsic, but rather it's often determined by the price that another investor is willing to pay. And so if you can think of gold, for instance, and that's what the bottom right-hand chart is showing you, gold for a very long time traded above or below its sort of average inflation adjusted price. But what we've seen since in the last 15 years or so, we've seen increased launch of derivatives and exchange traded assets that enable much more speculative interest in gold as a result. And what we've seen since the launch, for example, the GLD ETF, just as an example, we've seen the real price of gold sort of stay at a permanently elevated level of over that period. And if we look at sort of another reason for the interest in cryptocurrencies is, in some cases, you have seen a real surge in the use case of other applications, such as the decentralized finance or DeFi movement. And that's more relevant to other cryptocurrencies like Ethereum, but that is an example of why sort of assets in this space have taken off, so to speak. If we move to think of just some of the risks that exist in this space, notably volatility, we see that typically, if we use Bitcoin as an example, volatility is persistently higher than other risky assets. So the orange line there is sort of the long-term average of Australian equities. As you can see, over sort of its historical period, it's an asset that's traded persistently above that. So the risks and the rewards, for that matter, have been much more akin to sort of leveraged equity funds. And you can sort of see just you've had periods of sort of 80% drawdowns twice already in the post-GFC environment. And just in the space of a few weeks, we've seen a 38% correction up to 20 May as well. And I should note here that explaining the price movements of these assets can be quite difficult. These markets aren't necessarily that liquid. And so you can see some, frankly, incredible price appreciation and falls in very short periods of time because it doesn't require that much marginal investment in a particular space to prompt a sizable price reaction. And so the latest Bitcoin drawdown, for instance, appears to be driven by a mix of a crackdown within China and cryptocurrency usage. And this is just an example of highlighting its fragility. Some sort of negative remarks from Tesla CEO Elon Musk have also been a contributing factor, it appears. So if we move next to look at some of the new developments in this space, firstly, we've got the idea of NFTs, which stands for non-fungible tokens. So fungible means the token can be sort of transmuted into something else. So if you think of gold, for instance, if I melt down a gold coin, I can use that to make a gold ring. It's a fungible component, whereas NFTs by design aren't. What they represent is an opportunity to own digital works of, for example, top sporting moments or artistic pieces. So an example of a sporting moment would be like a famous three-pointer in the US NBA. A digital record of that moment would be one such example, and that in fact is what that left-hand image shows. The top shot is a partnership of the NBA to launch a new type of collectible. And what happens is the record of ownership gets stored on a blockchain and creates proof of authenticity for the owner. So what this does is enables a stronger chain of possession. It also enables, to an extent, ease of trade in these collectibles. And lastly, and one reason you shouldn't find this space too crazy is we've already seen with the internet age growing connection between artists and their fans in a variety of different media. And you could certainly see NFTs as just an extension of that trend, where it enables fans to express their support for a given artist. Now, some of the weaknesses in this space include the fact that just with other collectibles, there often isn't a fundamental basis for their value. It's very much reliant on what the next marginal buyer is willing to pay for it. Another weakness is the actual rights don't get necessarily transferred. So the original owner, say in the Top Shot case, the NBA, can continue to replicate those same moments. Now, of course, they're incentivized not to flood the market with them, but the fact remains is they still very much own that IP, and they could potentially create more of these NFTs of the exact same moments as ones they've already sold if they so chose. if we continue on to look at some of the trends in this space, we're seeing auction houses such as Christie's treating these very much as an extension of traditional artworks. We've seen considerable growth with total sales in the hundreds of millions of US dollars. One work pictured to the left there sold for US 69 million at auction recently, just to give you an idea of how much some people are willing to pay for these pieces. Really, this is extending sort of what we've already seen, quite strong growth in collectibles and artworks over recent decades. For example, one thing from some of you, one example would be just the surge of interest in Pokemon cards. That's just one case. There's plenty of other artworks that's seen a strong surge in price appreciation as well. And so to give you an idea of how big the art market is, it sells tens of billions of dollars annually, and even in a depressed period like 2020 was, we still saw $50.1 billion of sales in US dollar terms. So high amounts being paid for art is not necessarily an unusual thing to see. So if we move on to look at the DeFi movement, and what we've seen historically is traditional finance is centralized with key businesses acting as middlemen. That's what we've seen evolve over time. And so, for example, if you want to buy shares in a company, you would use a stockbroker. If you wanted to open and use a bank account, you would use a bank. Now, DeFi stands for decentralized finance, and the idea is really trying to break down that status quo and imagine in a world of sort of financial assets and markets that aren't controlled or channeled through those middlemen. And so there's a driving principle here where some of its key proponents are trying to envisage a world where we see less fees extracted by these third parties. So if you want to think of some of the alternatives that may be developed in the future, or in some cases already in use, a status quo example is a bank account or a bond that pays interest to its owner. A DeFi version would be a cryptocurrency protocol paying out crypto assets or currencies like Ethereum's at higher yields. One example is you're essentially doing a form of securities lending. So something large index funds do already is they essentially allow short sellers to borrow their securities for a time and earn a little bit of extra yield as a result. And we've already seen examples of that be developed with these cryptocurrency assets as well. Another example is exchanging currencies at the bank. The DeFi equivalent would be transacting directly with other people to using cryptocurrencies as the medium to come in at a lower transaction fee for both parties. And lastly, another example would be sort of using lawyers, conveyancers, banks to exchange existing assets. The alternative would be to sort of swap ownership via smart contracts on the blockchain. So the idea is that whole process can be automated and really cut out the need for all those third parties to the transaction. What we should note, this space is still very much in its infancy and subject to some considerable risks, including regulation. Much of this space isn't what I would say adequately regulated at the moment, and there's potential for a lot of change as and when regulators start to exert themselves on the space. So if we want to conclude with some of the risks and consequences to consider, as I just mentioned, much of this space remains unregulated. So that means traditional protections available to investors aren't there. And arguably regulation is required. If we think about why the status quo of the world is the way it is, for example, why is it difficult to send money overseas? Well, one reason is the alternative would make activities such as money laundering a lot easier. And in fact, we've already seen cases where cryptocurrencies have been used to enable those very activities. Another risk to factor in is the scope of for permanent loss of capital via theft, leverage. Some of these crypto assets are very much jokes. They weren't designed with a demonstrable use case. So Dogecoin pictured there is one such case where what we've seen in recent months is people bidding up this asset, even though it doesn't actually have sort of a demonstrable use case. Ethereum, for instance, has very much an entire digital ecosystem that's forming around it. Dogecoin has none of that development. It doesn't have a code base that's been developed either. It's really just a case of people speculating and driving the price higher. A fourth factor to consider in that space is government bans or confiscation is also a live possibility, and we've seen that across several countries in the world already. As I already touched on earlier, cryptocurrency asset volatility is considerably higher than conventional risky assets, making it quite an uncomfortable investment to hold for clients. And lastly, there can be taxation consequences for participating. So, for example, in the Australian context, there can be CGT implications from the buying and selling of cryptocurrency assets. And even the more sort of elaborate securities lending examples I gave might fall afoul of tax consequences as well. So in conclusion, I've given you an overview of an introduction into the cryptocurrency space and the blockchain, highlighted some of the latest investment trends, and delved into some of the new developments in this space, such as NFTs and DeFi. And importantly, we note that at present, these are not financial products and advisors cannot make recommendations on these as a result. This webinar is designed to just give you more information and equip you in those client discussions. And just on a final note, be aware of the risks in these markets. Thank you.